In our last video, we introduced you to the basics of Japanese candlestick charts. Today, we'll dive deeper into its many patterns, a powerful tool for deciphering market sentiments and trends. These patterns are like clues to the Sherlock investor, revealing hidden insights that guide better-informed investment decisions. Get ready to uncover market mysteries and elevate your investment strategy with the language of lights and shadows in candlestick chart patterns. Welcome to dooacademy. The candlestick chart is made up of tall, short, fat and thin candles, while its patterns can be formed by single, double and triple candles or bars. In this video, we'll be exploring the different types of single bar candlestick patterns. First, let's look at bullish and bearish Marubozu candles, which are also known as black and white Marubozu. Now remember, a candle may have any color, but the most common ones are white or green for a bullish candle, and black or red for a bearish one. We'll be using green and red in this video to indicate a bullish and bearish signal respectively. Bullish candles are characterized by their long bodies, which represent a significant price difference between the opening and closing prices. Its upper and lower wicks or shadows are relatively short or non-existent. These candles typically appear when the buying pressure is strong, and the selling pressure is relatively weaker. It suggests a potential future uptrend or a rebound in stock prices. However, when a bullish candle appears, it's important to be mindful of potential traps and not rush into buying. Make sure to always confirm the stock's position, overall trend, and trading volume first. If the candle is accompanied by increased trading volume, it may indicate a bullish market sentiment. On the other hand, if the trading volume decreases, it could be a deliberate attempt by market makers to push prices higher and lure investors in, so a cautious position is advised. The bearish candle, on the other hand, indicates the opposite. They also have long bodies, but the closing price is significantly lower than the opening price on the same day. This implies a bearish sentiment, indicating strong selling pressure and a price decline during the trading day. Investors often view bearish candles as potential signals for an impending downtrend. It's worth noting that when the body of a bearish candle is longer, it signifies stronger downward pressure, and traders should interpret the pattern wisely. Not all bearish candles signal price declines. When they appear in the later stages of a downtrend, it suggests that the bearish momentum might be exhausted, and it could be an opportunity to consider going long. The spinning top pattern is a candlestick with a particularly short body, with long upper and lower wicks. This is because the opening and closing prices are close to each other, creating its short body. This pattern signifies a tug-of-war battle between buyers and sellers, with neither side gaining the upper hand, which reflects indecision in the market. When a spinning top forms, it releases a potential reversal signal. Cautious traders usually postpone trading and wait for more definite signals before making decisions. Hammer and hanging man patterns share a similar appearance, with a small body and a lower wick or shadow that's 2 to 3 times longer than the body. While they look alike, the key difference is that hammers appear in downtrends, while hanging man patterns emerge in uptrends. The hammer pattern suggests weaker selling pressure and stronger buying power, which signals a price reversal and an upward move. It is often considered a buy signal in technical analysis. Hanging man patterns typically occur when the price is approaching a new high from the previous one. After the opening bell, a surge of selling pressure drives the price down sharply, which results in a sharp price downturn. This indicates weaker buying power and stronger selling pressure, leading to a reversal and price drop. Hanging man patterns are generally viewed as bearish signals. Next, a shooting star resembles its namesake, with a long upper wick like a tail and almost no lower one. When a shooting star opens at a higher price than the previous closing, it indicates a potential price reversal and is considered a bearish signal. When sellers are pushing the price down, it turns a bullish candle into a bearish one. The doji is a neutral candlestick with no body and tiny wicks. Its appearance indicates a balance of power between bulls and bears, signaling a possible market reversal. When you spot a doji, it's wise to exercise caution as it suggests uncertainty. Now there are 4 types of dojis. First, the long-legged doji has an extremely small body, indicating that the opening price and closing price are nearly the same. Its distinctive feature is its exceptionally long upper and lower wicks. This pattern is a signal that buyers and sellers were evenly matched during a specific time, causing significant price swings, but ultimately returning the price near where it started. If it shows up at the market's low point, it suggests a potential price bounce upwards, and the opposite if it appears at the top. Next, the dragonfly doji, also known as T-star, has similar opening and closing prices, with only a lower wick. This formation may indicate support after a price drop, especially when it occurs at lower prices, potentially signaling a reversal and buying opportunity. Third is the gravestone doji, which usually appears after a price rise. It has the same opening and closing prices, with a longer upper wick and almost no lower one. The longer the upper wick, the stronger the bearish signal. Finally, a four-price doji is a highly uncommon pattern, which appears when the opening, closing, high, and low prices during a specific period are all exactly the same. Last but not least, a bullish belt hold typically emerges after a price decline and generally indicates a bullish signal. It opens with a gap down, creating a sense of despair in the market, but then rapidly rises, showing strong bullish momentum. A bearish belt hold, on the other hand, especially during an uptrend, suggests a market stall or reversal. When traders spot this signal, it's often wise to reduce positions. Single bar patterns are just the tip of the candlestick iceberg. To steer your investment ship safely, use them wisely alongside other technical indicators and good old fundamental analysis. So, which of these patterns do you see lighting up your trading strategy? Be sure to like, share, and follow dooacademy for more actionable investment insights.